Good afternoon. I'm Aaron Osman, Managing Director of Wealth Management here at Arbuthnot Latham, and welcome to our quarterly investment webinar. Today, you're going to hear from colleagues Henry Norton, our Senior Investment Manager, and Jason De Silva, Director of Global Investment Strategy. Jason is going to address some of the key developments taking place in the global economy today and cover our macroeconomic assessment. Henry will then share some of the trades that we've enacted in portfolios in recent months. We'll aim to conclude our session by 1 p.m. Following the main presentation, we'll allow some time to ask any questions you might have. To ask a question at any time during the webinar, please just click on the Q&A icon at the top of your screen and a box will open up which you can pop your question into. To start, I'd like to share a quick business update as well as covering some of the investment decisions we made in our prior quarter, just to recap on those. On 1st of April, I'm pleased to announce that we launched the TM Arbuthnot Latham funds. The fund range comprises 3 risk levels, which are designed to reflect the decisions of the investment committee and the trades that we've made across our discretionary core services. The funds thereby provide access to our investment services at a lower entry level to better support our clients and your families. Please follow through the QR code on the screen if you wish to see any more information about the funds and more about them. In Q1, the key portfolio change that we made was an increase to global equities, whilst tilting within the asset class towards emerging markets. We also highlighted limited upside for government bonds at the time and reiterated the continued importance of portfolio diversification. And we maintain this mantra today. Forecasting the path of the global economy is never easy, but predicting geopolitical events is even more challenging. One could point out that tensions were certainly elevated as we were led into the US and Israeli conflict in Iran, but few had expected it to escalate quite so quickly into full-scale war. Such events remind us of the critical importance of diversification and active portfolio management. Our January decision to increase equities was based on the fundamental strength of the global economy, supported by the momentum of the tech sector's mega AI data center build-out. Whilst the increased equity position initially detracted from performance through the early phase of the Middle East conflict, markets were just as quick to bounce back to all-time highs following a pause in the conflict on expectations of a normalization of energy markets, and most importantly, in recognition of a particularly healthy underlying economy and strong company earnings momentum. Meanwhile, the oil market's knock-on impact to inflation has forced investors to reassess their expectations for global interest rate policies, which has resulted in short-term losses for bondholders benefiting our underweight allocation. To talk you through these and other important topics today, I now pass you over to Jason. Thank you.
Thanks, Aaron, and good morning, everybody. So what I'm going to do is just chat you through some of our thinking, and particularly the elephant in the room, the Iran-US conflict, and how we've thought about constructing a playbook on a massive geopolitical event. So I think the first thing to mention is, of course, these shocks can be quite alarming. And secondly, they're highly uncertain in terms of its trajectory. How we try to play it is just think about how geopolitical events have transpired and how markets have taken them on in times gone by. And the good news is, over the course of history, what we've found is when you've had geopolitical events of this magnitude, more often than not, markets tend to recover quite quickly, both during an event or after the conflict's resolution. And you can see this in the graph here, where we have median performance of global equity markets over time, post a geopolitical shock. And you can see the solid green line. On average, they tend to recover fairly swiftly. And this is what we've broadly used as a playbook for managing the geopolitical crisis this time around. I think an important thing to mention is where we see the impact from this conflict is more in the inflation market than growth at the moment. Of course, with oil prices being above $100, markets were quite, at the first instance, quite nervous that this might downgrade growth. But it seems to be that the growth dynamic within the global economy remains relatively resilient. But we are starting to see signs that inflation might be a bit stickier. And as this conflict seems to be in a bit of a muddle through process at the moment, with oil remaining elevated, it seems the impact is a lot more stronger on the inflation front. It's not to say that we are unaware of the risk or unconcerned about the risk. I think the situation is extremely fluid. The longer the conflict goes on, the larger the hit to inflation will be. And over the course of time, so too will the impact on growth as well. So we're extremely conscious of the situation. And if there is any dramatic increases in tensions or full out war, we'll manage portfolios accordingly. So what has that meant for what we've done in portfolios? Like I say, the playbook that we've used is markets have tended to look through these events and recover quite swiftly. And so using that playbooks, we mildly increased our exposure to equities. As Aaron mentioned, we came into the crisis overweight equities based on a resilient growth outlook for the global economy. And as I mentioned, whilst the crisis has been quite stark, it seems like the global economy remains resilient. Secondly, what we've been extremely encouraged on in global equity markets is earnings have been particularly strong. Now, a large driver of this has been the AI story, which we'll touch on later. But that's given us the fortitude to hold on to equities and also increase it slightly during the crisis. The big other asset allocation call that we've made is to decrease our government bond and global corporate bond exposure quite significantly. As I've mentioned, we think the impact on inflation is going to be a lot higher than for global growth. And the number one asset that is sensitive to inflation is bonds. And so what we've decided to do is, take down the exposure and reinvest some of those bonds into both equities and into cash. The reason why we've increased cash is, in times like this, which are extremely volatile, we see a lot of opportunities kind of come through the woodwork, and so we want to keep that in store for capitalizing those opportunities. To give you some idea on the timing of the trades, what we've got here is a graph of the dark blue line, which is global equities. That's our exposure. And then the performance of corporate bonds and government bonds in gray. And so what you can see, what we did is, if you look at that red line, is when we decreased our bond exposure, both government bonds and corporate bonds. And then what you can see from the green line is when we added equities. During the course of the last couple of weeks, you can see global and corporate bonds have remained relatively stagnant, while global equities have gone back to their all-time highs. So at the moment, it's turned out to be a decent trade, but of course we'll see high events transpire in the coming months. So what does that mean for our global macroeconomic assessment? As Aaron mentioned, it remains extremely hard to call and volatile and can change by the week. Broadly, what we still feel is the global growth remains extremely resilient. That's remained the case. We think the reason why that has transpired is, firstly, the CapEx cycle from artificial intelligence remains a structural trend, and that's really upholding the global economy. We still have stimulus from the likes of Germany, Japan, and to a certain extent, China as well. And of course, both household and corporate balance sheets remain relatively resilient as well. The big change that we've made in terms of our assessment from last quarter is inflation. We think inflation will be above target for the coming year. And that, of course, means that central bank policy, whilst remaining in a pause mode for the moment, is more likely to see upside pressure as those inflation expectations start to creep up, as businesses start to pass on the prices from increased oil prices, increased gas prices, and fertilizer prices as well. Equity valuations, while remaining expensive, have derated a bit, which is quite encouraging and what we'll touch on going forward. But nothing to be alarmed with at the moment from a global macro economic assessment standpoint, notwithstanding, of course, severe shock in energy markets. We're going to go to our poll for today. And, very basic question, when do you think the Strait of Hormuz will open? We've got 1 month, 3 months, 6 months, 12 months. If you don't mind just putting your votes on the poll pop up there. Okay, great. So we have our results, and it is a close race between 3 months and 6 months. So we have 48% of the vote going to the Strait will open in 3 months. And then we have 42% for 6 months. We've got this one lone individual who's very optimistic with a 1 month opening. Hopefully that individual is right. And then we've got 7% of very bearish, thinking it only opens in 12 months' time. Perfect. So just talking to individual trades, which I'll cover a little bit, and then Henry as well. As I mentioned, we obviously, one of the big asset allocation calls we made was to reduce bonds in favor of equities. And just expanding on our thinking somewhat, in this chart here, what you have is the valuation of corporate bonds in the turquoise line, and then the valuation in equities. And basically what this chart is showing is the higher the higher those lines are, the higher the valuations. And what you can see is over the course of the year is on a per unit basis, corporate bonds are actually more highly valued than equity valuations. How corporate bonds are valued is basically what you do is you take the government bond. Let's use the gilt market as an example. The 10-year is trading roughly around 5%. That's what government gets as their risk-free rate, and then corporates tend to trade at a spread above that, typically 100 to 150 basis points if it is an investment grade security. And so that range at the moment for corporate bonds is extremely tight. So you're not getting much return for the risk that you might take in buying corporate bonds. And we think equity valuations are a lot more attractive relative to corporate bonds. And so that's also another reason why we've increased equities as well. Why have equities become cheaper over the course of this conflict? Of course, during the conflict, you did see equity prices go down somewhat, but more importantly, is earnings have increased quite rapidly. Again, that's due to artificial intelligence in the main, but from a totality standpoint, margins still remain relatively elevated across corporates around the world. That's the big call that we've made across this quarter, but I'm going to hand over to Henry, who's going to touch through some of our equity allocation and through some of the opportunistic trades that we've done as well. Over to you, Henry.
Thanks, Jason. I wanted to spend some time highlighting a couple of the trades that we've made this quarter. So starting with our equity positioning. Within equities, we've increased our exposure to emerging markets, US major tech names, and the semiconductor industry. Focusing first on emerging markets, they've delivered strong earnings growth in recent periods, and a key driver of this has been their pivotal role in the global artificial intelligence supply chain. While much of the narrative around AI focuses on the US technology giants, the reality is that emerging markets sit at the heart of the physical infrastructure that enables AI to function. At the center of this story is Asia, particularly markets like Taiwan and South Korea. These regions dominate the manufacturing of semiconductors, advanced chips, and electronic components that power AI data centers. And as demand for AI computing surges, so too has the demand for these high-performance components. This is translated directly into stronger revenues, expanding margins, and positive earning surprises for many companies in those regions. Take Taiwan, for example, where TSMC, the leading global semiconductor manufacturer, has experienced a significant uplift in both volumes and pricing power. Or South Korea, where we have seen increased memory prices lead to significant margin expansion and demand for their major memory manufacturers. The right-hand chart shows this in blue, with expectations for chip exports from South Korea continuing to rise despite the ongoing conflicts. The global race to build AI capability has led to substantial capital expenditure from hyperscalers and US tech firms, and much of this spend flows through to emerging market exporters. Beyond the semiconductors, the benefits extend further. This flow of investment is beginning to feed through into a wider range of sectors, such as industrials and materials, and over time, this should benefit emerging market economies as a whole, especially when we expect to see continued US dollar weakness, the benefits of which we have discussed in previous webinars. Crucially, this earnings growth has come at a time when valuations in many emerging markets remain relatively attractive compared to their developed market peers. This combination of structural growth driven by AI exports and more modest starting valuations has created a compelling backdrop for investors, ourselves included. Following the start of the Iran war, we have seen oil prices increase significantly, recently trading around $100 to $110 a barrel. As a committee, we sought to find a way where we could protect the portfolio against longer-term elevated oil prices while still delivering strong absolute returns for our investors. We have done this by purchasing a structured product. A structured product is an investment that combines different financial instruments like bonds or derivatives to deliver a specific return linked to the performance of an asset or market. In this instance, we have purchased a product which will pay a 10% coupon if the price of oil stays above $47 a barrel in 1 year's time. As the chart on the right shows, we believe this to be a strong return for our clients at an oil price which is rarely seen in recent times, especially given the current environment that we find ourselves in. If we do continue to see elevated oil prices and a weaker economy, this position will not only protect capital, but will deliver strong absolute returns, allowing us to rotate into areas of the market where we see value in the future. I will now hand over to Erin, who is going to highlight some of the questions we're getting asked by our clients on a regular basis.
Jason, Henry, thank you for two very insightful updates there. This is often the case, gives us plenty to think about, and I'm sure we'll raise a few questions from guests on the call. As a reminder, to ask a question, please just click on the Q&A icon at the top of the screen and you can type in your question through to us and I'll moderate them shortly. Before we address any questions raised on the call, as we have done in prior webinars, I'd like to share the top queries that have coming from clients during meetings and calls over the past quarter. So I'll bring Henry back on the screen for the first one, which really addresses UK politics. It's been dominating headlines once again. How's this impacting portfolios, Henry, and how are we playing this?
Yeah, thanks, Erin. It's definitely a question that we're hearing very often, and clearly it's front page news at the moment in the UK. So clearly there is a lot of news about potential challenges to Keir Starmer, and there's a lot of speculation regarding who will be Prime Minister of the country and what their potential policies will look like. We think it's probably very early to start speculating on this, especially given that the current potential favourite to take Starmer's position, which is Andy Burnham, still is yet to be elected into Parliament, and the contest or election that he will have to run in is likely to be hotly contested, with pretty much all the major parties announcing that they're going to stand a candidate in that election. In terms of how we look at current political uncertainty and our investment approach, it's always been to keep our heads out of the day-to-day noise and news flow. Our aim is to remain disciplined and focused on the underlying economic drivers rather than speculating on policies that are yet to be decided. And amongst this uncertainty, there is one thing that we have changed. Previously, within portfolios, we held long-dated US Treasuries as a defensive position within the portfolio. We've recently reallocated this into long-dated UK gilts. We believe this reflects a relative value opportunity. Yields on UK gilts have moved to historically elevated levels versus US Treasuries, partly driven by this recent political uncertainty. And In our view, that spread looks relatively stretched relative to the fundamentals. So if we do see these fundamentals normalize over time, UK gilts could benefit from both a higher income that they receive versus US Treasuries at the moment, as well as potential capital appreciation as yields come down. And we've just seen this morning with UK inflation data coming out below expectations. Actually, some of this spread started to close and decline. So in essence, rather than kind of reacting to the short-term political noise, we use it as an opportunity to identify valuation opportunities and then reposition our portfolios accordingly.
Great, thank you, Henry. Second thing that has come up, unsurprisingly, and we have touched on this earlier, indeed, the whole of guests on the call were somewhat more optimistic. Just about just over half of you suggested that we'd see the Strait open within the next 3 months, either 1 or 3 months' time. But there's still a fair number saying 6 months or even 1 year. So let's take the more bearish scenario there, Jason. What happens if the Strait doesn't reopen and we are looking at it remaining closed for as long as a year?
Yeah, obviously very important question, Aaron. And look, I think the short answer is, of course, the longer the conflict goes on, if it stretches to the year to 12 months from here, it will be bad news. Kind of no getting away from it. However, I will caveat that with a number of things. I think in the first instance, the market's initial reaction, so in the initial stage of the conflict, we saw oil price higher, a lot higher than where it is to today, on fears of exactly what the big fear there is, where you've got 20% of energy supply going through the Strait of Hormuz pre-conflict. And if you just do very basic arithmetic, that means disaster for the oil price. Why has the oil price been a little bit more contained than initial market forecasts? I think it's down to a number of things. The first thing is, coming into this year, inventories in the global oil market were a lot more elevated than we've seen in the last few years. So just using crude maths, we roughly entered into the year with about 8.5 billion barrels of oil inventory across the globe. That compares to the last 5 years, where it was around 7.5 billion barrels. So that means that we came quite well supplied into this crisis. And what that's meant is, with excess reserves, a lot of businesses, a lot of countries have been able to draw on those inventories to contain oil prices. So that's helped. Secondly, as well, we have seen some demand destruction, particularly in Asia, where we've seen rationing from countries. And then thirdly, as well, whilst it is very severely curtailed, there has been some tankers going in and out of the Hormuz as well. So those three factors have led us to, while the oil price, still north of $100, nowhere near the $150 to $200 where the market initially thought at the opening stages of the conflict. So that's the good news. From the research that we've read, from people that we've talked to, this kind of environment can last to beginning of July, mid-July. So that gives us roughly 2 further months before things get very hairy in terms of supply constraints. So that's a key date to look out for. I think the other thing to mention as well, and one of the geopolitical analysts we follow quite regularly, just because there's no deal doesn't mean you don't have things come through the Strait. You could get to a stage where, while there's no deal, while there's no clear escalation, oil kind of goes through the Strait on an ad hoc basis, which kind of just tempers the worst of the oil price, $150, but still keeps it relatively elevated. So there is a middle way. But look, definitely the longer it goes on, inflation will go higher, and eventually it will lead to growth degrading.
That's great. Thank you, Jason. Let's indeed hope that it does open sooner than later. Okay, we have a question submitted, which Jason, I'll bring you back on for, which interested for your thoughts. It's a question, discussion on equities being cheaper than bonds. What sectors or geographies are currently looking cheaper?
Yeah, that's a great question. So kind of converse to what you'd expect. Actually, tech and particularly semiconductor companies are actually looking cheaper. And why is that? Obviously we've seen a lot of these companies have significant increases in share price, but that's been more than offset by the earnings increases. So to give a good example, Micron Technology, which is a memory player and has done fantastically well over the last year, increasing something of the order of like 500 to 700%. And you'd think, valuations would be extremely elevated given that share price movement, but it's actually gone cheaper. So it is trading at around a forward PE of 6-7 times, which is extremely cheap for for an equity. And that's just because the earnings are so strong. Conversely, a lot of AI players are trading cheap. The Magnificent Seven companies on a relative basis are trading relatively cheap as well. In terms of more specific geographies, on a relative basis, Europe and certain parts of EM are cheap as well. And of course, the UK. As many of you know, UK has been a perennially cheap market, high dividend yield, and given the deluge of oil companies within the FTSE 100, and given where the oil price is, we've seen strong earnings there, and so valuations have come down. So, yeah, there's a few territories that are looking relatively attractive, and then, as I mentioned, despite the strong share price performance, tech and Mag 7 is actually not that expensive either.
Thanks, Jason. We've got time for one more question, which I'm going to throw to Henry here, something that's come up a few times in conversation. We've got hopefully a series of IPOs coming to the market, SpaceX, Anthropic, potentially OpenAI, what used to be known as unicorns. These are private billion-dollar companies. These are private trillion-dollar companies potentially coming to the market. So we'll call them narwhals for now. What does this mean for equity markets? Investors likely now to get their hands on these companies because of the need for capital. What's your take?
Yeah, we'll have to wait and see, Aaron, if that name sticks for them. But clearly there's a lot of excitement regarding some of the businesses that are likely to IPO at the back end of this year, and especially given those companies are all at the forefront of technology. But probably highlighting one of them, if we take SpaceX as an example, clearly if Elon Musk's plans come to fruition, it's going to be very hard to estimate the potential revenue of space travel, space mining, or even kind of potentially the colonization of other planets. However, I would say probably in the near term, there is risk that these companies are coming to the market at quite expensive valuations. SpaceX is speculated to come to the market at a valuation of around about $2 trillion, making it the highest valued IPO of all time. And that's despite last year only having revenues of around about $15 billion. So clearly the majority of that price is based on those future expectations. To put it into context, that puts it at a price to sales ratio of around about 130 times. And for reference, Nvidia, which is the largest company in the world, with a really strong growth pipeline, at its peak, it traded at a price to sales ratio of around about 37 times. So clearly there is a lot of hype and a lot of belief that these companies will achieve some really strong earnings growth. I think the risk is that even if these companies do achieve those growth targets, if too much of that growth is already embedded in the price, then it might limit the potential upside for investors who get in at the IPO stage. In terms of our perspective, through our investment process, we prefer to invest in diversified regional allocation, and therefore we don't tend to actively participate in IPOs. Our feelings are that once these companies list and they begin to participate in the regular reporting requirements that the markets have, then the markets will find and value the potential future opportunities that these companies have. And hence, once we find that more settled valuation, we as an investment committee can decide where we want to participate in those companies via the funds that we invest in, only if those valuations do look attractive for us.
Thank you. Both Jason and Henry, thank you very much for your time today, and thank you all for taking the time to join us this afternoon. It is 1 o'clock, so we will wrap up the session there. We do hope you enjoyed our thoughts on markets and the ways in which we are playing those within portfolios. Should you have any feedback, please feel free to reach out. We have recently shared our latest investment committee series document. If it's not something you've received already and would like to take a look, then please do reach out to your relationship point at Arbuthnot Latham, and we'd be more than happy to send one through to you. Thanks again for taking the time, and have a lovely day.